On December 3rd, 2024, a seismic shift occurred within the global financial architecture that JP Morgan Chase has spent 15 years trying to prevent at all costs. For over a decade and a half, the largest bank in America has operated under a shield of perceived invulnerability, dominating the precious metals markets through a complex web of paper derivatives and vault control. But on that specific Tuesday, the shield cracked. JP Morgan received formal delivery notices for 5.2 million ounces of physical silver contracts. In the world of high finance, this was not just another transaction. These were contracts that could not be rolled over to a future date. They could not be settled in paper currency, and they could not be ignored through regulatory back channels. This event signals the death of a fundamental assumption that has governed the COMEX silver market since the great financial crisis. That assumption was simple. When a contract expires, the buyer will always prefer to take the cash profit instead of the physical metal. For years, this allowed banks to sell an infinite amount of paper silver, knowing that nobody would ever show up to claim the actual bars. But as silver crossed the threshold of $59 per ounce, that convenience vanished. The market has shifted from a game of digital numbers to a desperate race for physical atoms. According to official exchange data, 95% of all silver futures contracts historically settle in cash. This means that for every 100 contracts traded, only 5 people ever demand the actual silver. This massive disparity created a perfect environment for what economists call fractional reserve commodity banking. Imagine a system where a bank promises 100 people they own the same bar of silver, betting on the statistical probability that only 5 of them will ever ask for it. This worked perfectly until the morning of December 3rd, when the buyers stopped asking for dollars and started asking for their metal. JP Morgan is now staring into a trap of their own engineering. They have positioned themselves as the single largest vault operator on the COMEX exchange, not because they wanted to be warehouse managers, but because controlling the vaults meant they controlled the optics of supply. By shuffling inventory between different vault categories, they could create the illusion of abundance, even as the real physical supply was dwindling. But the delivery of 5.2 million ounces in a single day proves that the illusion is no longer sufficient to satisfy the market. We are no longer talking about theoretical shortages or conspiracy theories. We are looking at the mathematics of depletion. The clock has started ticking for the biggest short sellers in history. If 5.2 million ounces represents just the opening salvo of a new trend where industrial and institutional buyers demand physical delivery, then the entire COMEX inventory is in grave danger. At this rate, the math suggests that the system is moving toward a total physical decoupling. This is the moment where the paper price and the physical price diverge, leaving those who only hold paper promises with nothing but worthless digital entries. The endgame for the silver market has officially begun. To understand why the current situation is so lethal for JP Morgan, we must first deconstruct the massive paper illusion they spent 15 years constructing. Between the years 2008 and 2020, JP Morgan Chase transformed the silver market into a digital playground where the laws of supply and demand were replaced by the laws of high-frequency trading and concentrated short positions. The foundation of this system was a deliberate disconnect between the amount of silver that exists in the real world and the amount of silver that exists on bank ledgers. According to data from the Commodity Futures Trading Commission, also known as the CFTC, JP Morgan held a concentrated short position that averaged 32% of the entire COMEX silver market for over a decade. In March 2020, this position reached a staggering peak of 40,550 contracts. This represented 202 million ounces of silver that the bank had promised to deliver. To put that number into perspective, it is more silver than the top 5 silver mining companies in the world produce in 5 years combined. How could a single bank sell promises for silver they did not physically possess? The answer lies in the mechanism of the paper market. In a standard futures exchange, prices are discovered through the trading of contracts, not the swapping of physical bars. JP Morgan realized that as long as they could control the price on the screen, they could discourage people from ever wanting the metal. They used a technique known as spoofing, which involves placing massive fake orders to sell silver, creating a false impression of a glut in the market. This would trigger automated selling from other traders, driving the price down. Once the price dropped, JP Morgan would cancel their fake orders and buy back their positions at a profit. In September 2020, the Department of Justice finally caught up with this practice, forcing JP Morgan to pay a record-breaking $920 million settlement for manipulating the precious metals markets. However, the fine was merely a cost of doing business. The bank never had to admit to the underlying structural fraud, the fact that their paper promises were backed by a fraction of the actual metal. This is the essence of fractional reserve silver. They operated on the assumption that they only needed to keep a small amount of silver in their vaults to satisfy the small percentage of people who actually demanded delivery. For 15 years, JP Morgan was the house in a casino where the dice were loaded. They controlled the vaults, they controlled the delivery process, and they controlled the price discovery mechanism. They could shuffle silver between the eligible and registered categories in their warehouses to make the inventory look stable, even when it was being depleted. This paper illusion kept silver prices artificially low, which in turn discouraged investment and made silver mining less profitable. It was a self-reinforcing cycle of suppression that worked perfectly until the regulatory environment changed and the paper world was forced to collide with the physical reality of international banking law. The turning point for the silver market did not come from a protest or a sudden discovery of new technology, but from a dense set of international banking regulations known as Basel III. For decades, banks like JP Morgan were allowed to treat paper silver, often called unallocated metal, as a high-quality asset on their balance sheets. In the eyes of the regulators, a piece of paper promising silver was just as good as the silver itself. This allowed for the massive leverage we discussed in the previous section, where 1 ounce of real metal could back dozens of paper claims. However, in June 2021, the implementation of Basel III changed the fundamental math of the banking world. Under these new rules, unallocated precious metals were reclassified from Tier 1 assets to Tier 3 assets. In plain English, this means that paper silver promises are now considered high-risk assets that require a 85% stable funding requirement. Banks can no longer count these digital promises as equivalent to cash or gold bars. If a bank wants to hold a silver position, the law now incentivizes them to hold the actual physical metal, specifically earmarked and allocated, or face massive capital penalties. This regulatory shift effectively shut down the fractional reserve silver game. It was no longer profitable for JP Morgan to maintain a massive short position backed by nothing but air. The international banking community realized that the systemic risk of having billions of dollars in paper, promises without physical backing, was a threat to global financial stability. Basel III was the silent bullet that struck the heart of the manipulation scheme. It forced the big banks to begin a multi-year process of deleveraging, trying to close out their paper shorts while simultaneously trying to acquire enough physical metal to meet the new compliance standards. This is why we have seen such erratic behavior in the silver market over the last few years. JP Morgan has been caught in a regulatory pincer movement. On one side, they must reduce their paper exposure to satisfy Basel III. On the other side, if they buy too much physical silver too quickly to cover those positions, they will drive the price through the roof, causing massive losses on the short positions they still hold. They have been trying to walk a tightrope, slowly closing positions without alerting the rest of the market to their desperation. But the window of opportunity to exit quietly has closed. The transition period for Basel III enforcement is reaching its final stages, and the market has noticed the bank's vulnerability. By making it legally and financially expensive to hold paper silver, Basel III has ensured that every major player in the market now wants the real thing. The safety net that allowed the shorts to thrive in 1980 or 2008 has been removed by international law. JP Morgan is no longer just fighting traders. They are fighting the very regulatory structure of the global financial system. In the world of commodity trading, there are certain numbers that act as psychological barriers, and then there are numbers that act as structural triggers. For the silver market, that number was $59 per ounce. Throughout 2024 and into 2025, silver had been consolidating. But when it finally crossed and held above $59 in late 2024, the fundamental economics of the entire supply chain shifted overnight. This was no longer just a price increase, it was a total breakdown of the short sellers' ability to control the physical flow of metal. The first group to react to the $59 threshold were the primary silver producers. According to mining industry data, at this price level, silver production becomes so profitable that major miners like First Majestic Silver and Pan American Silver gained the ultimate leverage. For years, these companies were forced to feed their newly mined silver into COMEX warehouses at exchange prices just to maintain cash flow. But at $59, they reached a point of financial independence. They began bypassing the exchange entirely, selling directly to industrial end users at significant premiums. Why would a miner deliver to JP Morgan's vault for $59 when a solar panel manufacturer in South Korea or a tech giant in Silicon Valley is willing to pay $62 for guaranteed immediate delivery? The second factor triggered by the $59 mark was the China arbitrage. In the Shanghai Gold Exchange, where physical metal is actually traded and delivered daily, silver prices were already hitting the equivalent of $62 in yuan terms. This created a massive $3 price gap. Arbitrage traders operate on a simple mathematical rule: buy low, sell high. They began buying silver from COMEX warehouses at the $59 paper price, loading it onto ships, and selling it in Shanghai for $62. In November alone, COMEX inventory dropped by 4.1 million ounces as metal flowed east to capture this spread. JP Morgan was effectively being looted of its physical backing by global traders who recognized that the American paper price was disconnected from reality. Finally, $59 triggered a procurement panic among industrial buyers. Companies that manufacture electronics, electric vehicles, and solar panels don't buy silver to speculate. They buy it because their assembly lines cannot run without it. When silver crossed $59, it signaled to every supply chain manager in the world that a physical shortage was imminent. The strategy shifted from just in time to just in case. These industrial giants stopped waiting for lower prices and started placing massive delivery orders to secure their production needs for 2025 and beyond. They became the very thing JP Morgan feared most: buyers who will never sell back into the paper market because they intend to melt the silver down and put it into a product. At $59, the exit liquidity for paper shorts simply evaporated, leaving the banks trapped in a room where the walls are closing in. The fundamental mistake made by major banks in their silver short strategies was viewing silver primarily as a monetary metal, like gold. However, by 2025, the reality of the global economy has proven that silver is first and foremost an industrial critical mineral. While gold sits in vaults as a store of value, silver is being permanently consumed at an accelerating rate by the technologies of the future. According to the Silver Institute, total industrial silver demand reached a record 700 million ounces in 2025, marking the first time in history it has crossed this psychological and physical threshold. The primary engine behind this industrial panic is the global race for renewable energy, specifically solar photovoltaics. Every solar panel requires silver paste for its conductive efficiency, and as the world races toward carbon neutrality, the scale of deployment is staggering. In 2024, the solar sector consumed 230 million ounces. By 2025, despite efforts to reduce the amount of silver used per cell, total demand surged because the sheer number of installations expanded globally. Manufacturers of advanced high-efficiency cells known as TOPCon and heterojunction models require up to 50% more silver than traditional designs. For these companies, silver is not an investment. It is a raw material that is non-substitutable. Joining the solar sector is the electric vehicle industry, which has undergone a fundamental transformation in its silver consumption patterns. A typical internal combustion engine car uses about 15 to 28 grams of silver. In contrast, a modern electric vehicle requires between 25 and 40 grams, and premium models with advanced driver assistance systems can use over 50 grams. With global EV sales reaching approximately 16 million units in 2025, the automotive sector alone now consumes over 60 million ounces of silver annually. This is a structural, permanent demand that does not return to the market through recycling for decades, if ever. The combination of these two sectors has created what supply chain managers call a procurement death spiral. When silver prices began to rise, these industrial giants did not sell. They panicked. In 2025, we saw major industrial users shifting their strategy from buying as needed to securing multi-year supply contracts directly with miners. This bypasses the COMEX exchange entirely, further starving the vaults that JP Morgan uses to back its paper contracts. When a solar manufacturer realizes that a $1 billion production line might stop because they lack a few thousand ounces of silver, price becomes irrelevant. They will pay whatever is necessary to guarantee delivery. This industrial floor of 700 million ounces means that even if every retail investor stopped buying silver today, the market would still be in a massive structural deficit. The shorts are no longer just fighting speculators. They are fighting the very infrastructure of the 21st century economy. To understand the gravity of JP Morgan's current situation, we must look back to the most famous event in silver history, the attempt by the Hunt brothers to corner the market in 1980. Nelson Bunker Hunt and Herbert Hunt, two billionaire oil tycoons, believed that paper currency was doomed by rampant inflation. Their strategy was simple and devastating: buy futures contracts, and instead of settling for cash, demand physical delivery of every single ounce. By early 1980, they had accumulated over 100 million ounces, driving the price from $6 to a peak of nearly $50. The Hunt brothers proved that a concentrated physical position could break the paper exchange. By demanding delivery, they forced the shorts to scramble for metal that didn't exist in the vaults. The entire COMEX market was on the verge of a total systemic collapse because the exchange simply did not have enough silver to satisfy the Hunt's demands. However, the Hunt brothers made one fatal mistake. They built their empire on massive leverage, borrowing billions of dollars to finance their positions. This made them vulnerable to the one thing they couldn't control: the rules of the exchange itself. On January 7, 1980, the COMEX implemented what became known as Silver Rule 7. This emergency measure effectively changed the rules in the middle of the game. It banned new long positions and restricted trading to liquidation only. This meant that while the Hunts were forced to sell or close their positions, no one was allowed to buy. Simultaneously, margin requirements were hiked to astronomical levels. When the brothers couldn't meet a $100 million margin call, the price of silver plummeted from $50 to below $11 in just a few weeks. The exchange had broken the Hunts to save the short sellers. But here is why 2025 is fundamentally different and far more dangerous for the banks. The Hunt brothers were a single family that could be targeted by regulators. Today's delivery pressure is not coming from two billionaires. It is coming from thousands of industrial corporations, sovereign wealth funds, and a globalized retail market. More importantly, the current price surge is driven by a real-world supply deficit and international banking laws like Basel III, which we discussed earlier. Unlike 1980, the regulators cannot simply pass a Rule 7 to stop the buying because the buyers today are the very companies that build the world's solar panels and electric vehicles. You can bankrupt a billionaire, but you cannot bankrupt the global industrial supply chain without collapsing the entire economy. In 2025, the emergency stop button that saved the banks in 1980 has been rendered unusable by the sheer scale and legitimacy of the physical demand. The most terrifying aspect of the current situation for JP Morgan is not a matter of opinion or speculation. It is a matter of pure, inescapable mathematics. To understand why the trap is now closing, we must examine the specific ratio of paper claims versus physical inventory. As of late 2025, the COMEX silver market is operating on a razor-thin margin that has historically preceded a total delivery failure. Let's look at the numbers. Total registered silver inventory, the metal that is actually available for immediate delivery, has fluctuated significantly. While it hit record lows earlier in the year, recent reports show it's struggling to maintain a stable floor as delivery demands surge. At the same time, the open interest, the total number of outstanding paper contracts promising silver, represents hundreds of millions of ounces. Historically, the ratio of paper claims to physical ounces has reached levels as high as 100 to 1. This means for every single physical ounce sitting in a vault, there are 100 people holding a piece of paper that says they own it. The system relies on the assumption that 95% of these people will never ask for the metal. But let's run a simple calculation. If the delivery demand rate shifts from the historical average of 5% to just 10%, the available registered inventory would be wiped out in a matter of weeks. According to data from 2025, we are already seeing this shift. Delivery volumes have hit record highs, driven by what analysts call a liquidity squeeze. In some months, the rate of delivery notices has exceeded the total amount of new metal entering the vaults. Furthermore, the eligible inventory, silver that is stored in the vaults but not designated for delivery, is often used as a psychological buffer to make the markets look healthy. However, much of this metal is already owned by private individuals, ETFs, and industrial users who have no intention of selling it back to the exchange. When JP Morgan is forced to deliver 5.2 million ounces, they are not just taking it from a pile of extra silver, they are depleting the very foundation of their deliverable stocks. At current depletion rates, the mathematical endpoint where registered inventory hits zero is no longer a distant possibility. It is a calendar event projected for the first half of 2026. When the vault door opens and there is nothing left to hand to the contract holder, the paper price becomes irrelevant and the physical price enters a vertical vacuum. The most compelling evidence that the silver trap is real does not come from independent analysts or market speculators. It comes directly from the source, JP Morgan Chase's own regulatory filings and strategic maneuvers. If you look closely at the bank's official SEC filings throughout late 2024 and 2025, you will see a pattern of behavior that suggests an institutional panic is unfolding behind closed doors. According to their third quarter 10Q report for 2024, JP Morgan's precious metals derivatives book saw a massive reduction in notional value. Simultaneously, their physical metal holdings increased by a staggering amount. Reports indicate that the bank added 21 million ounces of physical silver to its stockpile in just 6 weeks during late 2024. For a bank that spent 14 years maintaining the largest short position in history, this is not a minor portfolio adjustment, this is a total reversal of strategy. They are closing their paper bets and hoarding physical atoms as fast as the market allows. Even more revealing is the strategic relocation of their operations. In late 2025, JP Morgan announced it was shifting its core precious metals team to Singapore. This move is significant because Singapore has become the global hub for physical bullion delivery and storage, away from the heavy-handed oversight and paper-centric rules of Western exchanges. At the same time, the bank moved 169 million ounces of silver from deliverable to non-deliverable categories within their vaults. This effectively locked up nearly 10% of the global annual silver supply, removing it from the reach of the very COMEX contracts they once used to manipulate the price. Perhaps the most telling piece of evidence is buried in the fine print of their risk management disclosures. In recent filings, the bank has updated its language regarding commodity exposure, noting that physical delivery demands may exceed available inventory during periods of market stress. This is corporate lawyer language for an admission of potential default. They are telling the regulators and anyone who reads the fine print that the physical silver simply might not be there when the music stops. JP Morgan is no longer betting that silver will go down. They are betting that the paper system will fail, and they are making sure that when it does, they are the ones holding the keys to the vault. As we move deeper into the endgame of this silver trap, the question is no longer whether silver will rise, but how fast and how high the vertical spike will travel. Based on historical squeeze dynamics, current industrial deficit data, and the deteriorating inventory at COMEX, there are 3 mathematical scenarios for the silver price as we head toward mid-2026. The first is the conservative scenario, with a price target between $120 and $150 per ounce. This scenario is based on a simple mean reversion of the gold-to-silver ratio. As of late 2025, gold has surged to record highs near $4,500 per ounce. Historically, during periods of monetary stress, the ratio of gold to silver tends to return to its long-term average of 40-1. If gold stays at $4,500 and the ratio normalizes to 40, silver mathematically reaches $112. Adding a 20% premium for the current physical supply tightness brings us comfortably into the $120 to $150 range. The second is the moderate scenario, targeting $200 to $250 per ounce. This calculation uses the 1980 peak price of $50 and adjusts it for 4 decades of monetary inflation. In 2025 dollars, the 1980 peak is equivalent to roughly $190. However, unlike 1980, when silver was mostly a speculative investment, today's market is underpinned by massive industrial consumption that did not exist 40 years ago. This scenario assumes that as JP Morgan and other shorts are forced to cover their nearly 1 billion ounces of paper promises, they will be competing directly with solar and electric vehicle manufacturers for the same dwindling supply. This double whammy of investment demand and industrial necessity creates a price floor far higher than any previous cycle. Finally, we have the vertical spike scenario, where silver could reach $295 to $350 per ounce. This is the panic procurement model. In this environment, the price is no longer determined by traders on a screen, but by the desperate requirements of global industry. If a multi-billion-dollar semiconductor or solar firm faces a production shutdown because they cannot source silver, the cost of the metal becomes irrelevant compared to the cost of a halted factory. At this stage, the market enters a melt-up phase where prices move vertically because there are no sellers at any price. We saw a version of this in the nickel market in 2022 when prices doubled in hours. With a paper-to-physical ratio still sitting at extreme levels, silver is the ultimate candidate for a similar vertical explosion. The timeline for these moves centers on the second and third quarters of 2026, as the inventory depletion we've tracked hits its mathematical zero point. We are standing at the threshold of the most significant transformation in the history of the precious metals markets. As we conclude our analysis in late 2025, the evidence is no longer a matter of debate. It is visible in the vault reports, the regulatory filings, and the skyrocketing spot prices that have reached $75 per ounce. The 14-year era of paper manipulation led by JP Morgan Chase has not just ended, it has imploded under the weight of physical reality. The vault drain crisis of late 2025, where 60% of registered silver was claimed in just 4 days, serves as the final proof that the paper exchange is a hollow shell. The Great Decoupling is now officially underway. This is the moment where the digital price on a screen and the cost of a physical bar of silver go their separate ways. We are seeing a historic failure of the arbitrage mechanism between New York and Shanghai, with premiums in China reaching $8 to $12 above Western prices. For the first time, the house cannot hide the shortage. JP Morgan, once the world's most aggressive silver short seller, has performed the ultimate pivot. Reports now indicate they have closed their entire 200 million ounce short position and accumulated a staggering 750 million ounces of physical metal. They are no longer the ones suppressing the price. They are the ones positioned to profit most from its explosion. For the investor, the manufacturer, and the observer, the lessons of 2025 are clear. First, you cannot suppress a critical industrial commodity indefinitely when the world is racing toward a silver-intensive green energy future. Second, international banking laws like Basel III have fundamentally relinked the financial system to physical assets. And third, when the largest bank in the world stops fighting the market and starts hoarding the metal, the smart money follows. The mathematical certainty we discussed, 30 paper claims for every physical ounce, has finally met its day of reckoning. As we look toward 2026, the projections of $100, $200, or even $300 per ounce are no longer conspiracy theories. They are the logical outcome of a fifth consecutive year of structural supply deficits and a market that has run out of physical buffer. The clock has struck midnight on the paper illusion. We are entering a new era of price discovery where atoms matter more than bits, and where those who own the physical metal will hold the power in the global economy. The trap has sprung, the shorts have been liquidated, and the true value of silver is finally being unleashed.